If you're holding gold in your retirement account right now, what I'm about to share could be the difference between watching your wealth evaporate or positioning yourself for what could be the most significant wealth transfer in modern history. And I'm not being dramatic here. The data I've uncovered tells a story that most financial advisors either don't understand or won't tell you. Let me start with something that should terrify anyone holding traditional retirement assets. While gold has been making historic moves, there's a hidden risk that almost nobody is talking about. And it's not what you think. It's not about gold going down. It's about the structure of how you're holding it and what that means when the system faces its next crisis. Here's what's happening right now. Gold has been on an absolute tear, hitting record after record. But here's the thing most people miss. The gold you think you own, you might not actually own. Let me explain what I mean by that. When you look at the gold market, there are two completely different worlds operating simultaneously. There's the physical gold market, where actual metal changes hands. And then there's the paper gold market, where contracts, ETFs, and derivatives trade at volumes that dwarf the physical supply by ratios that would shock you. The COMEX, which is the major exchange where gold futures trade, operates on something called fractional reserve. Sound familiar? It's the same concept banks use with your deposits. For every ounce of physical gold in their vaults, they've sold claims on that same ounce multiple times over. Some estimates put this ratio at over 100 to 1. Think about that. 100 people think they own the same ounce of gold. Now that works fine when everyone's playing nice and nobody's asking for delivery. But what happens when the music stops? We're seeing the early warning signs right now. Central banks have been accumulating physical gold at a pace we haven't seen since the early 70s. And they're not buying paper gold. They're demanding physical delivery and storing it in their own vaults. Why? Because they understand something that most retail investors don't. When confidence in the system cracks, paper promises become worthless. Only physical metal matters. Let me paint you a picture of what this looks like on the ground. There's a vault in London, part of the LBMA system, where gold bars are stacked floor to ceiling. These bars have serial numbers, and they're supposed to represent the gold backing various ETFs and institutional holdings. But here's what's fascinating. Those same bars, with those same serial numbers, have been pledged as collateral for multiple different claims. It's like selling the same car to 5 different people and hoping they never all show up to take possession at the same time. Now, before we go further, I want to mention something quickly. I've put together a free guide that breaks down the savings secrets thousands of American retirees are using right now to protect their hard-earned wealth. It's in the description below. This isn't some sales pitch. It's actual strategies and information you need to understand what's happening to your money. Grab it while it's still available. Back to what's unfolding. The reason this matters so much right now is because we're entering a period where the demand for physical gold is starting to overwhelm the paper market's ability to suppress prices. You see, for decades, the paper market has been used as a price discovery mechanism. When too many people wanted to buy gold, the big banks would simply sell more paper contracts, flooding the market with supply that didn't actually exist in physical form. This kept prices in check. But that mechanism is breaking down. Here's why. The traditional buyers of gold, jewelry manufacturers in India, electronics companies, even individual investors, they've been joined by a new class of buyer that changes everything. Sovereign nations, countries that are actively trying to reduce their dependence on the dollar system. They're not buying gold to make a profit. They're buying it as a strategic asset to back their currencies and protect their reserves from sanctions and devaluation. When China buys gold, they're not checking the spot price and trying to time the market. They're accumulating as much as they can get their hands on, regardless of price. Same with Russia, same with the BRICS nations, same with central banks across Asia and the Middle East. This is a structural shift in demand that the paper market simply cannot satisfy. And here's where it gets really interesting for anyone holding gold in a retirement account. Most people who own gold in their IRA or 401k don't actually own physical metal. They own shares in an ETF, or they own a certificate that promises them gold, or they have some other form of paper claim. And when the squeeze comes, when physical demand overwhelms paper supply, those paper claims are going to face a reckoning. Let me tell you about what happened in the nickel market recently. It's a perfect preview of what could happen in gold. The London Metal Exchange had a massive short squeeze, where the price of nickel went absolutely parabolic in a matter of hours. The exchange's response? They canceled trades. They literally rewound the clock and pretended those trades never happened. Why? Because allowing the squeeze to play out would have bankrupted major banks and brokers who were on the wrong side of the trade. Now imagine that scenario playing out in gold. Except gold isn't just another industrial metal. It's the foundation of the entire monetary system, whether officials want to admit it or not. When the paper gold market faces its squeeze, and it will, the response is going to make the nickel situation look like a minor hiccup. Exchanges will halt trading. Contracts will be settled in cash instead of metal. And anyone holding paper claims is going to find out the hard way that their gold was never really theirs to begin with. This is why the structure of how you hold gold matters more than ever. Physical gold in your possession, or in a vault where you have allocated storage with your name on specific bars, that's real ownership. Everything else is a promise. And promises break when the system is under stress. Let's talk about what's driving this crisis that's coming. It's not just one thing. It's a convergence of factors that are all pointing in the same direction. First, you've got the debt situation. Global debt has reached levels that are mathematically impossible to repay in real terms. The only way out is inflation. Devalue the currency, make the debt worth less, and hope you can grow your way out of the hole. But that destroys purchasing power for everyone holding that currency. Second, you've got the geopolitical fragmentation. The world is splitting into competing blocks. The dollar's role as the global reserve currency is being actively challenged. Countries are settling trade in their own currencies, they're building alternative payment systems, and they're backing those systems with gold. This isn't speculation. This is happening right now. Third, you've got the physical supply constraints. Gold mining production has been essentially flat for years. The easy gold has been mined. New discoveries are rare, and the cost of extraction keeps rising. Meanwhile, demand is exploding. That's a recipe for a supply squeeze that could send prices to levels that seem absurd today. But here's what most people miss. The price of gold in dollars is almost irrelevant. What matters is what gold can buy. What matters is gold's purchasing power relative to other assets. And by that measure, gold is still historically cheap. You can buy more stocks, more real estate, more bonds with an ounce of gold today than you could at various points in history. That tells you something. It tells you that gold is undervalued relative to the bubble and everything else. Think about it this way. If you owned gold in the early 70s, before Nixon closed the gold window, you could buy about 15 barrels of oil with 1 ounce. Today, you can buy over 30 barrels. Gold's purchasing power has increased. But in dollar terms, gold has gone from $35 an ounce to thousands. The dollar has been devalued. That's the key insight. Gold doesn't go up. Currencies go down. And that's the risk nobody's talking about with retirement accounts. Your 401k, your IRA, they're denominated in dollars. When the dollar loses purchasing power, your retirement loses purchasing power. It doesn't matter if your account balance goes up, if what that balance can buy goes down faster. This is the hidden tax of inflation, and it's accelerating. Now here's where this gets personal for anyone watching this who's sitting on retirement savings. You've worked your whole life, you've saved diligently, you've done everything right according to the conventional wisdom. And now you're facing a situation where the rules are changing. The system that was supposed to protect your wealth is becoming the mechanism that destroys it. I want to take a moment here because this is important. If you're holding significant retirement assets, if you've got over $100,000 in any retirement account, you need to understand how gold IRAs work. I'm not talking about buying gold stocks or gold ETFs. I'm talking about holding physical gold inside your retirement account, where it's protected from taxes, but you have real ownership. I put together a comprehensive guide on exactly how this works. It's in the description. It covers the process, the rules, the custodians, everything you need to know. This isn't about making a quick buck. This is about protecting what you've spent decades building. Because here's what's coming. We're entering a period where the traditional 60-40 portfolio, stocks and bonds, is going to fail spectacularly. Bonds are getting destroyed by inflation. Stocks are overvalued by almost every historical metric. Real estate is in a bubble in most markets. Where do you hide? Where do you preserve purchasing power when everything is inflating? Gold has been the answer to that question for 5,000 years, not because it's a great investment. Gold doesn't produce anything. It doesn't pay dividends. It just sits there. But that's exactly the point. Gold is the ultimate form of savings. It's wealth that can't be printed, can't be debased, can't be inflated away. It's the emergency exit from the monetary system. And right now, the smart money is heading for that exit. Not in a panic, quietly, methodically. Central banks are buying, billionaires are buying, sovereign wealth funds are buying. They're not doing this because they think gold is going to double next year. They're doing it because they understand that the current system is unsustainable and gold is the asset that survives the transition to whatever comes next. Let me give you a specific example of how this plays out. In Weimar Germany, during the hyperinflation, people who held gold maintained their purchasing power. People who held marks, the currency, were wiped out. A loaf of bread went from costing a few marks to billions of marks. But in gold terms, the price of bread barely changed. Gold wasn't going up. The mark was collapsing. We're seeing echoes of this today. Not hyperinflation, not yet, but currency debasement on a scale that's unprecedented in peacetime. The money supply has exploded. Government spending is out of control. The Federal Reserve is trapped between fighting inflation and preventing a deflationary collapse. They're going to choose inflation. They have to. Because the alternative is a debt default that would destroy the entire system. This is why gold is moving the way it is. It's not speculation. It's not a bubble. It's a rational response to an irrational monetary policy. People are waking up to the fact that their dollars are being systematically devalued, and they're looking for a store of value that governments can't manipulate. But here's the critical point. Not all gold is created equal. The gold you hold in an ETF, that's a claim on gold. The gold you hold in a certificate, that's a promise of gold. The gold you hold in a futures contract, that's a bet on the price of gold. None of that is the same as physical gold in your possession or in allocated storage where you have direct ownership. When the crisis comes, and it's not a matter of if, but when, those distinctions are going to matter more than you can imagine. The ETFs will suspend redemptions. The certificates will be settled in cash at prices that don't reflect the real market. The futures contracts will be force liquidated. And anyone who thought they owned gold will find out they owned a promise that's being broken. This has happened before. In the 70s, when gold was soaring, the futures exchanges changed the rules mid-game. They went to liquidation-only trading, meaning you could sell, but you couldn't buy. They raised margin requirements to levels that forced small traders out. They did everything they could to break the rally and protect the shorts, and it worked, temporarily. But the underlying fundamentals didn't change. Gold eventually went much higher. We're going to see the same playbook this time, except on a much larger scale. The amounts of money involved are staggering. The leverage in the system is unprecedented, and the political stakes are higher because this isn't just about commodity prices. This is about the credibility of the entire fiat currency system. Think about what it means when gold goes to $5,000, $6,000, $10,000 an ounce. It's not that gold is becoming more valuable, it's that the dollar is becoming less valuable. And if the dollar is becoming less valuable, what does that mean for your retirement account that's denominated in dollars? What does it mean for your Social Security that's paid in dollars? What does it mean for your pension that's calculated in dollars? This is the conversation nobody wants to have, but it's the conversation we need to have. Because the people who understand this early, who position themselves accordingly, they're going to preserve their wealth. The people who wait, who trust the system to protect them, they're going to learn a very expensive lesson. And here's the thing, you don't need to be a financial genius to understand this. You just need to look at history. Every fiat currency in history has eventually failed. Every single one. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created. That's not a conspiracy theory. That's just math. And the pace of that devaluation is accelerating. Gold, on the other hand, has maintained its purchasing power for millennia. An ounce of gold could buy a fine suit in Roman times. It can buy a fine suit today. That's stability. That's what real money looks like. Everything else is just a medium of exchange that's constantly being debased. So what do you do with this information? First, you educate yourself. You understand the difference between real assets and financial assets. You understand the risks in the system. You understand why gold has been money for 5,000 years and why that's not going to change just because some economist says we've evolved beyond it. Second, you take action. You don't need to go all in on gold, but you need to have some. You need to have real physical exposure to the one asset that's going to maintain its value when everything else is being repriced. And you need to structure that exposure correctly, not through paper claims that can be broken, through actual ownership of physical metal. Third, you stay informed. This situation is evolving rapidly. The moves that central banks are making, the shifts in the geopolitical landscape, the stress building in the financial system, these are all accelerating. You need to be paying attention because the window to position yourself is closing. The people who are going to come out of this okay are the ones who see what's coming and prepare for it. The people who are going to get hurt are the ones who assume the system will protect them, who trust that their retirement accounts are safe just because they're in a 401k or an IRA. Let me be very clear about something. I'm not saying the sky is falling tomorrow. I'm not saying you should panic. What I'm saying is that we're in the late stages of a monetary experiment that's never worked in history, and the smart money is already positioning for what comes next. You can either be ahead of that curve or behind it. And if you've made it this far in the video, you're clearly someone who takes this seriously. You're someone who's willing to look at uncomfortable truths and make decisions based on reality rather than hope. That's exactly the mindset you need right now. So here's what I want you to do. First, check out that guide in the description. It's going to give you a much deeper dive into the specific strategies and structures you can use to protect your wealth. Second, if you're serious about this, if you've got over $100,000 in retirement savings, I'm offering an exclusive one-on-one educational web conference. No obligation, no sales pitch, just a detailed walkthrough of your specific situation and what options make sense for you. This is only available to American retirees who mention they watched this video all the way through. The link is in the description. The bottom line is this: we're living through a historic shift in the monetary system. The old rules are breaking down. The new rules haven't been written yet. And in that transition, gold is going to play a central role. Not because I say so, because that's what always happens when fiat currencies fail. The question isn't whether gold is going to preserve wealth. The question is whether you're going to position yourself to benefit from that, or whether you're going to be one of the people who wishes they had acted when they had the chance. Your retirement, your financial security, your ability to maintain your standard of living in the years ahead, all of that depends on decisions you make right now, not next year, not when things get worse, right now. Because by the time everyone sees what's happening, it's going to be too late to position yourself effectively. Gold isn't a speculation, it's insurance. It's the ultimate form of financial insurance against a system that's showing every sign of stress. And just like any insurance, you want to have it in place before you need it. Because once the crisis hits, the price of that insurance goes through the roof and the availability disappears. So take this seriously, do your research, understand what's at stake, and make the moves that are going to protect what you've spent your life building. Because this isn't just about making money. This is about not losing everything when the system that's supposed to protect you fails to do its job. And if you think that can't happen, you haven't been paying attention to history. It always happens. The only question is whether you're going to be ready when it does.